All right, today we're going to talk about a strategy that's all about tapping directly into the engine of India's future growth. We're diving into the world of small cap companies and how a really disciplined investment plan could be the key to unlocking their huge potential. So let's get right into it.
So let me ask you a question. Where do you look for the next big thing? You know, the companies that aren't just growing, but have the potential to grow exponentially over the coming decade?
Well, for a lot of savvy investors, the answer is right here, in the small cap space. Now, these aren't the household names you hear about every day, but they could absolutely be the giants of tomorrow.
And that brings us to our first section, the small cap opportunity. Let's really dig into what makes these companies so special and why they might just be the ticket to riding India's next big wave of economic growth.
So what's the deal with small cap companies? What makes them tick? Well, for one, they're way more agile and innovative than the big established players. Their size means they're literally poised for exponential expansion. I like to think of them as seeds, you know? They have all the potential inside to grow into these massive trees.
Okay, so why is everyone talking about this right now, especially as we're looking ahead? It really all comes down to the deep connection between these small companies and the health of the entire Indian economy.
You see, as India keeps getting stronger on the world stage, it's not just the huge conglomerates that are pushing things forward. The real engine, that grassroots energy, so often comes from these smaller, up-and-coming companies.
But look, let's be real. Investing in smaller companies means more volatility, more ups and downs. So how on earth do you manage that risk? Well, that's where the SIP safety net comes in. It's all about a disciplined way to approach this exciting, but sometimes challenging market. So what exactly is a systematic investment plan, or SIP? Honestly, it's beautifully simple. It's just a commitment you make to invest a fixed amount of money, say every single month, no matter what the market is doing. The most important word here? Discipline.
And this discipline leads to something really powerful called rupee cost averaging. Think about it like this. When the market is down and prices are low, your fixed monthly investment automatically buys you more units of a fund. When prices are high, it buys you fewer units. Over time, this smooths out your average purchase cost, and it helps you navigate the bumps of the market without having to stress about timing anything. It's genius, really.
Okay, so you get the what and the how, but the big question is, which fund do you actually choose? Let's get practical here with a 5-point checklist to help you pick a real champion.
This is your game plan. First up, performance. Don't just look at one great year. You want to see consistent outperformance over a good 5 to 7 year period. Second, the manager. Who's steering the ship? Do your homework on their track record through good times and bad. Third, the expense ratio. This is so crucial. Lower fees mean more of your money is actually working for you. Fourth, diversification. You want to make sure the fund isn't putting all its eggs in one basket, not too concentrated. And finally, philosophy. Does the fund strategy, is it growth-focused, value-focused? Does it actually match your own comfort level with risk? But hey, don't just take my word for it. Let's hear from two of the most respected leaders in the Indian market and get their take on this very strategy.
First, we have Radhika Gupta, the MD and CEO of Edelweiss Mutual Fund, and she has a really clear, no-nonsense message about what it takes to succeed here.
And her advice is pure gold. She says the absolute key is to just hold on for the long term. We're talking 10 years, maybe even more. She's basically saying you've got to ignore the scary headlines and the short-term noise. It's all about patience and trusting the process.
Next up, let's hear from Nilesh Shah, the Managing Director of Kotak Mahindra Asset Management. He has this fantastic analogy, and it's especially great for anyone who's kind of new to investing.
I love this way of thinking about it. He compares the market to a swinging ball. It's unpredictable, it's hard to time. So what's his advice? Don't even try to hit it perfectly. Instead, he says, play in the V, which is his metaphor for the steady, disciplined approach of an SIP. It's about consistency, not trying to be a hero and timing the market.
So we've covered the opportunity, the strategy, and we've heard from the experts. Let's pull all of this together into a clear action plan with the most important takeaways you need to know. If you only remember one number from this entire explainer, please let it be this one: 7+ years. That is the bare minimum time frame you should plan to stay invested to really give yourself a chance to ride out the market cycles and see that growth potential come to life.
And of course, we got to be responsible here. It is absolutely crucial to understand that small-cap funds come with higher risks and more volatility than large-cap funds. So please always do your own research and read the official documents carefully before you invest a single rupee.
And just to wrap things up, let's hit a few final quick facts. First, you don't need a fortune to get started. You can start a SIP with just a few hundred rupees a month. Second, remember, time is your absolute best friend for smoothing out those market bumps. And third, yes, of course you can lose money in any stock market investment, but a SIP strategy is one of the best tools out there to help manage that risk over the long haul.
So, I'll just leave you with this final thought. When you look at the incredible potential ahead for India, the real question is your portfolio actually ready to capture the next decade of that growth?